Good morning and welcome to another episode of Nasdaq Spotlight. My name is Leanne Alfaro, and we are here today to talk with a few speakers, attendees, and experts in the area of REIT on the heels of the iGlobal REIT Summit happening tomorrow in New York City. So joining me right now is Kenneth Weissenberg, who's a partner at EisnerAmper. Thank you so much for joining us.
Glad to be here.
So tell us let's start a little bit by talking about the reduction in tax, in top corporate tax rate. Are REITs still a viable form of enterprise?
Well, corporate tax rates dropped from 35% down to 21%. And while REITs really don't pay corporate tax because they get a deduction for paying dividends, the recipients of the dividends get a 20% tax break on the dividends that they get. So if you look at the income earned from source, dollar to pocket, in a corporation, the corporation pays 21%, the shareholder pays 20%. It's approximately the 35% rate they used to pay just at the corporate level. For the REITs, the shareholders get a 20% deduction against their 37% bracket, so they end up paying like just a shade under 30%. So there is a tax benefit to REIT shareholders for owning, their income through REITs. So REITs still have a place in the overall scheme of things.
Great, and that's good to hear. So now, what are some of the advantages then of utilizing REITs for foreign shareholders, for example?
Well, foreign shareholders, basically, they don't want to have effectively connected income. So if they're holding their income through a partnership, they actually have to file U.S. tax returns for the income coming through from a partnership. If it's coming through a REIT, they basically just have withholding on the REIT. If they own less than 10% of the REIT stock, they can sell the REIT stock without having U.S. tax on the gain. So that's a major advantage.
Absolutely. Now, how does the new 20% deduction for qualified business income impact REITs and any publicly traded partnerships at that?
Well, for income coming from a flow-through business, which is any kind of business that's a real trader business, including real estate, the income would be subject to a 20% tax deduction, so that the top rate drops to a little under 30%. For any kind of business, that deduction is limited to 50% of wages or 25% of wages plus 2.5% of property subject to depreciation. That's not the case with REITs and publicly traded partnerships. That income is automatically qualified for the 20% deduction. So it makes it much easier if you're holding interest in businesses through a REIT, real estate businesses through a REIT. You don't have to go through those tests. You get your dividend. It's 29.6 maximum rate. It's not a bad deal.
Now tell me, the new tax, it created a special tax benefits for investors in opportunity funds. So what are some of those benefits?
Well, for an opportunity fund, if you roll a capital gain into an opportunity fund, you don't pay tax currently on that gain, which is a nice benefit. If you hold the fund for 5 years, 10% of the gain goes away. If you hold it for 7 years, another 5% goes away for a total of 15% complete forgiveness. And the tax on the deferred gain is due at the end of 2026. If you hold the fund for 10 years, the gain on your sale of the interest in the fund is completely exempt from tax. You get a step up in basis equal to the value when you sell it, which is a great concept. So you get the benefit of deferring your gain and excluding gain from your investment in the future.
Absolutely. Now, what kind of gain then is eligible for investment in these opportunity funds, which you semi-covered?
Different from like-kind exchanges, where you have to basically sell a piece of property and buy a piece of property of the same kind. So real estate for real estate. They changed the rules for like-kind exchanges, so it only applies to real estate. So you used to be able to trade like art for art, a horse for a horse. It's only real estate now. For this new opportunity zone, you can trade any kind of gain into an opportunity zone. So it could be from stocks, it could be from bonds, it could be from real estate, from artwork, basically anything that you sell at a gain, you can roll the gain into the fund.
And what happens if I invest more than just my gains?
Well, it's treated as two investments. The investment of the gain qualifies for the deferral and the exclusion after 10 years. The other is just a purchase of an interest in a fund.
Okay. All right. Well, Kenneth, thank you so much for joining us on this episode of Nasdaq Spotlight, and we certainly hope to see more from the iGlobal REIT Summit. So thank you so much for joining us, and hope to have you back soon.
Should be a great summit.
Okay, perfect. Nasdaq followers, stay tuned for more coverage and more from speakers from the iGlobal REIT Summit.